folks. Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory. Thought we'd come to you today with a brief market update, kind of let you know what's going on out there. It's been kind of a bumpy start to November, not necessarily down all that much, but feels like a lot of up and down during the beginning of the month. The S&P 500 right now is at about 68.18 as I'm speaking, for those of you who like very precise numbers. That's up about 16.2% year to date. Down about 1% since the end of October, really driven by a couple of factors. The first thing that's going on out there is all of the news around the government shutdown. Is it shut down? Is it opening back up? Obviously, we saw as there was some economic contraction, people actually started to miss paychecks, et cetera. The market was, not liking that all that much. And then when we saw the news over the weekend that it looked like the government is going to reopen, the market reacted positively to those numbers. I will say the same thing about the government shutdown that I've said in the past. The market generally views that type of event as a very short-term event, not something that is really all that impactful as they think about earnings expectations for companies 6 months, a year, 2 years out. So the market typically tends to look past that type of stuff unless they feel like whatever is going on is likely to sort of permanently dent consumer confidence or maybe take a chunk out of unemployment, cause some sort of other long-lasting unintended consequence, which we will come to in a second. So we have the government shutdown issue out there. Feels like it's been sort of largely dealt with, assuming that we can get the government back open and gradually get all the services associated with that back into place. Second thing that's going on out there is more of a positive. It is earnings season, or it is earnings season is largely done at this point. And it was a pretty good one. So we've had about 450 companies report so far. Of those, we've seen earnings growth of about 12%, 11.8% year over year increase versus about an 8% expectation. So a reasonably good earnings season, certainly supporting valuations on the AI side. And that brings me to the sort of third point that's out there, which is just this general concern about valuation. I see a number of articles that are out there. I get some inbound client conversations about the overall valuation of the marketplace. Anytime we tend to get these, anytime we're hitting new highs in the marketplace, people start to talk about, how high the PE ratio is, et cetera, et cetera. And the interesting thing about those types of valuation arguments is that they're largely self-correcting. When you get some type of sell-off as a result of those valuation concerns, now all of a sudden the market's less expensive. And so the market doesn't react. The sell-offs tend to be pretty shallow and somewhat short-lived. If you were concerned that the market was too expensive, sells off by 5% or maybe 6%, you give up a little bit, but now all of a sudden those multiples look a lot more attractive. And so long as there's nothing fundamental underlying the sell-off other than just, hey, valuations seemed high, those valuation-led sell-offs don't really tend to last very long. Which actually brings me to the fourth point that's sort of driving the market. And I feel like this is sort of an undercurrent driving the market, which is just sort of where is the consumer and how is the consumer feeling? We got consumer confidence data sort of late last week, which wasn't great. Some of the lowest readings really since the pandemic coming through in terms of the consumer's overall health and consumers' overall thoughts on the economy. That is troubling and concerning. And I think it's one of the reasons why the government shutdown news, when it came back, was welcomed by the market was, okay, let's go ahead and start to get people paid again. Let's go ahead and start to get air travel restored. Let's go ahead and start to get some of these services back in place. Because what we don't want to see, we really don't want to see that consumer confidence move any lower, particularly not in an environment where unemployment is still in an acceptable range, but maybe a little elevated relative to where we would like it to be. We get a little concerned when we see consumers start to be worried that may impact their spending patterns. And certainly that's the last thing that the economy needs is a sort of slowdown in overall consumer spending. So that is something that we are sort of keeping in the forefront of our minds. And hopefully, once we get the government back up and running, we can get some economic data to give us a little bit of more recent read on things like unemployment, other things that might be going on with the consumer. It has been a little choppy here at the beginning of November, but I wouldn't say it's largely down or up. This is just sort of normal market volatility when we get around these types of times in the marketplace. With that, as always, if you have any questions, please feel free to reach out to myself or to your advisor. I hope you're having a great day, and I look forward to talking to you again soon.